Hello everyone, welcome back. I got a lot of really good ones for you today on this Saturday, January 21st, 2023. Wanted to give you guys a quick update of how markets were moving, developments inside the different markets, the economy, geopolitics, and then on the back end, I was going to give you guys my perspective on the difference between trading, investing, and stacking. A lot of people kind of confuse these things, but they're all different games requiring different hats with a different paradigm. So I think I'll be able to give you guys a pretty interesting perspective on the back half of this brief, but in the meantime, let's hop right into these markets. The three major US stock indices have been doing quite well for the entirety of the year so far. We've been seeing the 10-year yield kind of come down over the last few weeks, brings down interest rates in the dollar, kind of gives risk assets a boost to include the crypto market way out on the end of the risk curve. We've been seeing cryptos even bounce quite nicely. Precious metals showing a lot of strength, oil showing a lot of strength, all three major US stock indices showing a lot of strength. So I think we have a Fed that's trying to constantly pour cold water on a lot of these rallies because the Fed doesn't feel like the inflation problem has been adequately addressed through these rate hikes. So every time the markets kind of get giddy because they feel like we're coming to the end of this Fed tightening cycle, the Fed kind of comes back out to pour water on these rallies and kind of tamper everyone's expectations around how much bubblier they're going to allow markets to get, because again, they're really trying to get inflation under control. But here's the thing, are they really? Because they're merely raising the Fed funds rate saying that's going to get inflation under control, when the reality is that inflation stems ultimately from expanding the money supply. And if you look at any metric, M1, M2, M3 for money supply or the Fed balance sheet, it all just continues to bubble up, right? So long story short, through the year so far, this last few weeks, we've been seeing yields, rates, and the dollar fall. Kind of stokes inflation being a sticky problem, and it stokes risk asset prices. Even those mortgage rates have been coming down at least a little bit. The 30-year average fixed right now is around 7%, but I think if mortgage rates can fall back into the 5s and 6s, that's going to leave interest rates, when you factor in the real rate of inflation, still deeply negative, and it's going to kind of buoy home prices. That's why you're seeing the Fed crush demand but not price tags, and that kind of goes for everything. The Fed's really good at crushing demand, but they thought they were going to be able to crush inflation at the same time, and those prices just aren't falling as quickly as they would like. So the market kind of knows this. The market's kind of been bluffing with the Fed's, calling the Fed's bluff regarding how hawkish the Fed was going to ultimately become. So whenever the Fed comes out and they're like, well, we think the terminal rate might need to even be 6% to get inflation under control, markets initially react to that and kind of freak out and want to deflate, but then ultimately the markets come to the realization that the Fed's going to keep the interest rates far lower than the inflation rate, which is going to mean interest rates are still in real terms negative, which is still going to allow risk assets to go up. So that's kind of what you've been seeing through 2023 so far, and the market's really stoked about getting these last couple interest rate hikes out of the way. We're probably looking at a 25 to 50 basis point hike like February 1st or 2nd, whenever the Fed concludes their meeting in the beginning of February. We'll see another little baby bump to the Fed funds rate. But then what? By summer, we're cutting. I mean, and that's kind of the rumor is by second half of this year, the Fed will be done with raising their interest rates, done with their quest to solve the inflation problem. And then we'll ultimately be looking at either just holding rates steady while we continue to inflate the money supply, or cut interest rates, would be rocket fuel for risk assets in these markets, price tag wise, and rocket fuel for inflation. So it's kind of what you got going on right now. Immense strength in the crypto space lately, strength in the oil space, strength in the tech-heavy NASDAQ, strength in the precious metals. So that's what you've been seeing all year. And been kind of crazy. I'm still tentatively bullish. Oil, physical gold, crypto, and high growth tech stocks. So the mega cap tech stocks like Amazon or Google or Nvidia or Tesla, I'm bullish on. Gold coins and silver coins, I'm bullish on, not the mining stocks or derivatives. Bitcoin, I'm bullish on. Ethereum, I'm bullish on. I like some of these ETH killers and some of these other altcoins too. So you have like ADA, HBAR, Polygon, Chainlink, Cosmos. You got a lot, Polkadot. So, some of those projects I'm tentatively bullish on. Look, none of this is a buy or sell recommendation, okay? Especially with the cryptos, non-registered securities, not speculative tech stocks that aren't even registered securities. 1 minute your money's there, poof, it's gone. I think Bitcoin is not to be lumped in with that. Bitcoin is, separate from the crypto space. You have Bitcoin and then you have the crypto space. But I'm bullish on both of those. Bullish on large cap oil. And for oil, I don't really like ETFs. I like the idea of buying quality large cap oil stocks like Chevron or Exxon, or if you wanted to dabble in uranium, you could go with like Cameco, CCJ. Not a buy or sell recommendation, but my experiences with oil is the ETFs like USO might break during an oil crash, and then some of the explorative, like the more speculative exploration energy companies that are like looking for a really big deposit of oil, and they're really small cap companies. I don't really like those. They're kind of akin to mining stocks, just usually don't work out. But I like large cap oil. I like large cap tech stocks. I like Bitcoin. I like Ethereum. And I like those gold and silver coins. So there you go. Nothing's really changed. Over the course of my last few videos, you'll kind of see that I've kind of been, wanting to focus on those four spaces for the last few videos, kind of make those the focus ever since the Fed has really gone off the rails with this whole hiking interest rates fiasco. So as the Fed kind of backs off from that, these risk assets out to the end of the risk curve, like the NASDAQ, oil, Bitcoin, and gold, they love it. It's rocket fuel for those prices. And more conservative investments like Procter & Gamble stock or real estate price tags will come along for the ride ultimately when the Fed gets these interest rate hikes out of the way and starts to think about cutting again. So yeah, that's kind of what you got going on in the markets. And then I wanted to talk about the difference between investing, trading, and stacking. And this kind of ties in with the 4 asset classes I told you I'm bullish on. So, this should be good. When you're investing, what you're doing is you're looking for something that is going to throw off cash flow. When you're trading, you're really just concerned with price. You're concerned with the price you get in at and the price you get out at. And in investing, you're not really concerned about the price you get in at and the price you get out at. You're concerned more with all the money you make in between. So here's an example. If I give you $1 million, you could go buy a really expensive house right now, or you could go buy a brick of gold. If you go buy a really expensive house, you're not really so concerned that you bought the house for $1 million and sold it at 1.2 million a few years later. I mean, that's nice that you captured that appreciation, but you captured those $10,000 a month rent checks that entire, period in between. It's throwing off cash flow. If maybe you take $1 million and you go put it all into a stock like Exxon, which is paying an 8% dividend. Well, you're not really concerned at the price you got in Exxon stock and got out of Exxon stock. You're concerned with that 8% dividend just reinvesting or throwing off income for the entirety of the time you hold it. So when you buy an investment, you're not really concerned with the cash in and cash out. You're concerned with all the cash you're going to make along this journey. And that does typically require a longer time horizon, right? Like it'd be hard to make any investment and say, I'm going to get my return within 2 years, because the amount of income that your investment's going to throw off is, it's probably going to be, somewhat, reasonable, nothing crazy, nothing like putting on a trade and buying $1 million worth of a penny stock at $1 and hoping it hits $1.50 by the close. Which brings me to my next hat. So in investing, we didn't really care about the price we got in at, the price we got out at. We cared about, a counterparty that was going to do valuable and productive work and throw off cash flow and income to us. That's what we cared about. And that's a whole different hat. If you're an investor, you might not stack any gold or silver. You might actually hate gold or silver because stacking is the antithesis of investing. It's to buy a value store and say, I don't trust anyone to do jumping jacks for me and throw off income. So that's investing. Do you see how it's not really about price you get in at and price you got out at and managing your risks as much as it's about, well, definitely managing risk, because you're going to want to, look at this potential house you're going to buy, what those numbers are going to look like, how much rent revenue you're going to be able to collect from your tenant. But, you're in the world of investing now, which is great. If you want to stay in that world and leave trading and stacking for the birds, I don't care. That's your prerogative. I don't neglect the other two hats or games that I can play, but if you want to just live in the world of investing, more power to you. Trading is quite a bit different. Trading price really comes into focus here, because if I'm going to, let's use the $1 million example. If I'm going to put on a trade with this $1 million, perfect example, about a week and a half ago, Carvana, stock ticker, is a CVRA, I believe, but it's Carvana, publicly traded. You can bring up the stock chart. I recommend you do it. About a week and a half ago, I texted some friends because it hit $3.68, and I was like, dude, I don't care who you are. Anyone should buy maybe 50 shares of that company just at $3.68. Just throw in a couple $100. I don't think anyone would regret that. And, within a matter of days, it was back to $8, So you doubled your money. You could have made, I know people that made 105% return off of trading that bounce in Carvana stock about a week and a half ago. And they've already closed the position. So what the heck happened there? Well, it certainly wasn't investing. It's not like I believed a month ago that Carvana belonged in every well-balanced portfolio. I really had no interest in that kind of stock. And, I'm not really following that kind of company, and I'm not really paying attention to the narrative driving it. But I did see the stock price was $340 last year, and it hit $3.68. That security was down 99%. And those moments, those just all-out capitulations where whatever firm was forced to liquidate their holdings, that price tag just fell so out of range and just so far out of bed that you could just swoop in with only maybe a 48, 72-hour window, nab up a few shares, and then dump it a week and a half later for 100%. We saw the same thing with Hertz car rental in 2020, okay? A great trade a buddy of mine put on. Bought his first shares of Hertz stock at 71 cents because Carl Icahn had just lost $18 billion in Hertz car rentals. So he picked up a bunch of shares at 71 cents. A few days later, he sold for over $5. Did he like Hertz car rental? Is he drawn to the car rental business? Is that his niche? No, he saw a security trading at an insane discount because of this horrible fear and capitulation in the market, and really putting a lot of emphasis on price and timing. He was able to go into the trade, make his money, and then leave. So that's not investing, folks. He wasn't going to make any dividend off of owning those Hertz car rental shares or Carvana shares. There's no dividend to be had there. It's the price you got in at and the price you got out at, which is ultimately gambling. But that's not to say there aren't poker players that are 80% skill, 20% luck, and they're able to find an edge. If you're a trader in Wall Street and you're correct 55% of the time, and wrong 45% of the time, you could probably get a great job at one of those banks. And if you're right 60% of the time and wrong 40% of the time, and you manage your risk well, you could probably run Goldman Sachs after a few years, because being able to manage risk well and having an edge that's even like 55-45 can be profitable. Even trading at 50-50. So when you buy a security, it's like flipping a coin. It's gonna like go up or down, you know what I mean? So you could technically be only correct on your trades 50% of the time, but if your losses are $25 and your wins are $250, you can go 50-50 all day long, lever up, So that's trading. It's not investing. And people are all like, oh, well, I made an investment and then it went down, and so now it's a trade and I'm out. Or I made a trade and then it went down, so now it's an investment because I'm going to wait for it to go back up. That's my favorite. Yeah, I put on a trade and hadn't really worked out. It's down about 19%, but I'm just going to wait a couple years, It's like an investment. It's like, no, dude, you started playing blackjack at the poker table. Like, stop. So if you want to put on an investment, hey, that's great. If you want to put on a trade, hey, that's great. Just know what you're doing going into it, what it is, and stick to that plan. I consider investing, well, that's like a real adventure, you know what I mean? Like starting a business, and putting your own money to work in it. That's like a real investment. A trade would be like, I have $10,000 sitting in cash right now. Carvana stock was $6 a couple days ago, already down a ton, and now it's $3.68. Should I buy some? This is max fear. That's a trade. And you might be like, I don't even like Carvana. I know nothing about it, but I have this price data point. I'm risking a little bit to make, I'm risking $1 to make $3. It seems worth it to me. I'm going in on this trade. And so if you make an investment, you might not have a stop loss on it. And if you make a trade, you might say, I'm going to put a stop loss on it. So if this trade moves against me by 15%, it's automatically going to take me out. I'm done. Carry on with the plan of life, and stick to your plan. Okay. So that would be my advice there. Don't go changing it up. Don't have these investments sour on you and now you're bag holding, or these trades sour on you and now you're calling them investments and you're bag holding. Don't do it. Don't hold bags. And then there's, so that's investing. Then we had trading, kind of discussed how those are different games, different hats, different paradigms, different strategies, different parameters. Don't get them confused. And then we have stacking, which is totally a different game and a different hat, but people still get really confused by it. So if you say, I give you $1 million, we'll use that example again, and you go out and buy a ton of gold, like you just turn it into a big block of gold and put it underground, it's not an investment, because it's not gonna spin off any cash flow. It's not gonna draw business. It's not gonna generate any sort of value. It's not gonna pay you a dividend or an interest rate. It's just gonna sit there. It's gonna sit there and be a big block of gorgeous gold. But it is a value store. It is the most stable asset on the planet. It is the money, and everything else is credit. And so if you wanna be a stacker, hey, more power to you. Just know you're not investing. And if you're buying gold, a big block of gold, that might be kind of like putting on a trade, but I wouldn't use gold as a trading vehicle, just put it that way. Meaning when you're a stacker, you're not like buying a big brick of gold and then selling it next week at to the same bullion dealer you bought it from, and taking some extra federal dollars that, because the dollar's weaker now. Like, you could do that, but I don't recommend it. A true stacker kind of makes it a one-way street. They know that gold and silver is a value store. They know that it carries zero counterparty risks. They know that it's not an investment because it's the money. It's a trust thing. I don't want to risk my value store with another person doing jumping jacks, hoping he brings more value to the marketplace. So when you're a stacker, it's a lot like storing real estate in a shoebox. And you might be like, well, then why don't you just buy real estate? Because there's maintenance. Gold has no maintenance. You can just store this stuff. Look, if you have a lot of it, you're going to need to pay for security. There's maintenance costs there, okay? It could even run you like, 4 or 5% a year. Like, it could really eat into whatever gains your gold's doing just by paying people to store the stuff. But otherwise, like if you just get a gold coin and you put it in a shoebox, like that's historically, that gold coin shares a relationship to X amount of ears of corn, X amount of baskets of blueberry, X amount of cotton, X amount of copper. You know, gold is just kind of like directly convertible to any of these other commodities that you could need and requiring zero maintenance. But you're not trading if you're just sticking a gold coin under your bed, and you're not investing because you're doing the antithesis of investing. You're saying, don't bring your counterparties around me. I just want this value store. So if you're a stacker, cool, good on you. I like it. It's all good in the hood. Keep doing your thing. There's an old saying, stackers never lose. I think that's pretty fair. It's pretty awesome because you don't really need to get caught up in a fundamental story. You don't really need to get caught up in prices. You just go to a bullion dealer or whatever, get some gold and silver in physical form, and hide it somewhere or store it somewhere safe, and rinse and repeat. Kind of make it a one-way street, and it's always there for you if you need it. Empires kind of come and go, but gold is one of those things that it's as good as gold, or the gold standard. So trading, investing, stacking, all completely different games. Know the difference, know fundamentally how that behavior is different from the others, and let it ride. I enjoy trading, stacking, and investing, and I encourage you to do all three. But hey, if you just want to stick to one, like, well, I'm just a trader, or I'm just a stacker, or I'm just an investor, it's all good in the hood. Do your thing. That's really all I got for you for right now. Thanks for watching. Like, subscribe, share, comment, whatever. You guys are awesome. I got your back. And remember, none of this is buy or sell recommendations. I'm not a licensed fiduciary. I'm just a guy in the world figuring it out like everyone else. Till next time.